Morning everyone, welcome to the brief. 1st of September 2017. August has finally come to an end and let's hope we start to see some volume come back into the market. It has been a particularly difficult August, I'd feel. We've had sudden bouts of volatility, but otherwise very choppy sessions involved there. So coming into September, I'm feeling optimistic. We're coming in December, more volume coming in, more risks on the horizon. We've got commentary coming out of the ECB. We've got the QE program coming to an end, and we've got the Fed, who still need to fulfill on their sort of communication of 3 hikes. So coming into the end of this year, I'm quite excited about market conditions. So let's see how September goes, taking us into the winter months. I'd like to start off by just having a look at the charts. Yesterday was quite an interesting day. If you look at the charts, however, it seems, well, Eurodollar in particular, it looks like it was quite a boring day. We came in the morning, we sold off, and then we bounced, basically finishing the day flat, maybe up just slightly on the day. But in actuality, what we saw was we started off with the Eurozone inflation. With the Eurozone inflation, we saw that we had a beat on the core and the headline inflation at 0.1% each, which didn't really cause much of a reaction. Eurodollar went to go test the highs of the day before we started to sell off. For full disclosure, I was going long just before the break of the high, sort of going long in around here, waiting for the break. It didn't really go much further. This was then followed on by the ECB source comments saying that policymakers are starting to feel uneasy about the value of the euro. This caused the euro then to sell off. You're breaking past S1, grinding down lower just to test these highs, which I know Anthony was pointing out in the chat earlier on in the day. I'm really looking at sort of these levels over here. Testing it, just breaking it slightly, but ultimately fully recovering as the American session went into full swing and into the close. This was also helped by the Treasury Secretary Mnuchin saying that having a weaker USD is somewhat better for US trade, but overall the long term, a strong USD reflects confidence. We saw a degree, this came about at 4:45, so we look at the charts here, put this onto a 10-minute. Looking at your Euro USD currency pair, 4:45. We saw some upside in the Eurodollar, went up to go test its highs, and I'm sure also it added to the fact that we ultimately managed to break the highs just as we were closing on the session. This wasn't anything outright, well, I couldn't really say hawkish, he's not a policymaker, but hawkish. But he's still a very influential person. He's the Treasury Secretary, and the market wouldn't have shrugged that off. But no real solid recovery, so to say, in the euro. So sorry, the so then looking across, we saw looking at cable yesterday. Cable was definitely the underperformer of the two of our major pairs yesterday. We pretty much saw sustained pressure throughout the day, finally going to test S2, which technically was actually a great level. The place where we bounced on, I was watching this market quite closely. It was all to do with these lows around here. You can see that ultimately this was the level which holds some significance here. And after selling off quite heavily, this is largely driven, I feel, not so much due to dollar strength, but sterling weakness. And you can see this when you're looking at your euro-pound cross, ultimately doing nothing. But this was the euro strength and dollar strength simultaneously. But coming down quite heavily, finding support at the S2 level, and also going and closing just modestly higher on the day, just taking out Thursdays and Wednesdays highs. But really, in terms of end of day price action, we hadn't moved much. And this is to be expected given the fact that we have non-farm payrolls today, the very important day, lesser so than what it used to be. And this is all we're going to discuss in just a moment when we touch upon non-farm payrolls. But again, it's not the jobs report or the jobs number or the headline which is going to have the most market significance. It's in fact going to be the average hourly earnings. We're going to touch upon that shortly, but this is to be expected. The market's not going to make any real move, especially in your US denominated products, so your US equity market, your dollar or your bond market. It's not really going to be making any move. Just just waiting for the data to come out and then being able to position themselves accordingly. There was one particularly interesting movie yesterday, and that was oil. This was a really good move here yesterday. Just technically breaking some levels over here. So this was Wednesday's high and then Tuesday's high, respectively. Ultimately, it was quite range bound in the morning, just going up to test R1. At this point, I wasn't reading too much into this, and Anthony's been explaining why we haven't seen much upside in oil, but we have seen upside in distillates, such as gasoline, and we'll talk about gasoline just shortly. But we're largely range bound, coming up to test the day before it's high. What I feel here is that we started to get some technical breakouts over here. Plus, there was, of course, market participants involved who were looking to go long oil, believing that, yes, it's the refineries which have been hit, but they should filter through into the oil market as well. So just taking out yesterday's high led us to a bit of a stop run. So short squeeze, driving higher, taking out, this is, I believe, so this is Friday, Thursday, Tuesday's highs over here, and then just sort of consolidating around R2. So quite a powerful move. Sort of came out of nowhere here. And finally, just in the equity space, I'd like to show you something which I've been working on. I'm not too sure how many people in the live room are have really looked at swing trading, but it's something I've been quite interested in for a while. Just to have some positions on in the background whilst day trading. So what I did yesterday, I put on my moving average cross, kept it nice and simple. I have a friend of mine who swing trades quite a bit, so he recommended the 21 and the 6 day. I popped that over there and I looked for the first cross I could see in the day, and that took place over here. Got in long here. This was just ahead of the US data as well, the PCE core numbers. If you're trading the swing, really, I wanted to see how it would work out. Ultimately, it worked out pretty well, looking for an exit around here. This is something I'd say if you guys have time and the markets are quiet, definitely look at swing trading. Especially looking at it historically, it works very well in any sort of trending market. In a ranging sort of market, fine, you can get a lot of choppy price action, but just looking for these moving average crosses, where the short-term volatility crosses that long-term volatility, looking to get in, predicting a swing in the market, and then when that short-term volatility crosses down, getting out and booking profit. It's been quite interesting. I'm going to be playing around with this for the next few weeks. I'll keep you up to date weekly on how that's going and sort of what trades I've been taking on. This was on the simulator. This particular gold one, I tried it on dollar yen recently, and that worked out pretty well on the short. Okay, so let's have a quick look at some of the headlines overnight. Let me start off by talking about the Kaizen Manufacturing PMI. Now, only about a month ago, no, it wasn't a month ago, it was about 2 months ago, we saw, how time flies, in May 2017, we saw this private manufacturing PMI number come in sub 50, which would then be contractionary, so it wouldn't be expansionary. And at this point, we started to see market fears. We saw US equities, Asian equities all start to sell off, as this was sort of indicating that we may see this sell-off on the back of a hard China landing once again. So many people were monitoring this as the months progressed, and then we saw a bit of a recovery, finally managing to get above 50, and then once again 51, and then we saw a very healthy 51.6 yesterday. So I think the sadistic side of me was kind of hoping this sub 50 number would continue and get to see some volatility, given the fact that we're already 1 quarter into 2017 and volatility was very scarce, to say the least. But this is now fully recovered. And likewise, if we then flick over to the US equity market, this coupled with that dollar weakness we were seeing, where is the equity chart? The equity chart display. That coupled with the dollar weakness and the stability and this political risk that we've been seeing has actually seen the US equity market start to recover nearly all of its losses, coming up to test quite a key level here, this triple top over here, S&P. We've tested it once, testing it twice, but once we get through there, really, we'll only have one barrier before the next technical level then becomes the all-time high. So we've seen quite a a strong recovery. And to put some numbers on it, let's get up our currency tool. Let's call that the lows. From the lows, we've now recovered 2.5%. Again, this is nothing impressive, but in current financial markets, a 2.5% move, and well, it's more impressive if we look at the most recent swing, which only took place 2.2%, and this took place in about 3 or 4 days. People trading in any time before 2017 would know that this is sort of volatility we would see, maybe in one session, maybe just in the American session, once the North Americans crossover. But an interesting market to keep an eye on. I wouldn't be expecting any sort of breakout trades coming ahead of non-farm payrolls, but definitely positive sentiment in the United States, and looking for a full recovery in the US equity markets. I truly feel unless we start to see really high average hourly earnings come out of the United States, we're going to see all-time highs stay in equity. It's a punchy call, it's R2, but unless we see average hourly earnings go up by 0.4, maybe 0.5%, all-time highs, very reachable today. So we look at European equities this morning as well. Yeah, just basically range bound. R1 containing the DAX quite nicely over here. Okay, so just while we're on DAX, let's talk about the ECB. So we've got this Reuters report where they took a poll, ECB to announce quantitative easing cutbacks in October, shut program by 2018, Reuters poll. I find this all very sensational. I think when I came in the morning, I sat down, had a look through some of the headlines, and I read ECB to announce quantitative easing cutbacks in October, shut down by program in the end of 2018. My hands were quivering. I couldn't log into QTrader fast enough. But then it goes Reuters poll. Bit of sensationalism there to get people excited. Still very relevant though. What they're saying here is the European Central Bank is likely to announce reduction of its monthly asset purchase programs in October, according to a majority of economists in Reuters polls, who also said they expect the central bank to shut down the program by the end of the year, which when they mean shut down the program, they mean the current asset purchase program of 60 billion pounds, 16 billion euros a month. Now in July, the ECB did come out and say they had not discussed reducing QE, but changes to come. They signal changes were to come by autumn. So now the market is really looking at October to be the time when Mario Draghi finally announces that he's going to cut back on his QE program. Market expectation is to go from 60 to 40 billion, and I think this is reasonable. If we October's coming up to the end of the year, October, November, December. Yep. So you got 1 quarter after October. He wants to get the markets prepared. Prepared for the impending tightening of monetary policy conditions. So it's going to be interesting to see how the market reacts to this. He's most likely going to announce that he's going to cut the quantitative easing program, but wrap it up in a nice dovish blanket, saying that interest rate, he may even sort of go back and start to say interest rates can go lower for longer, whilst most recent communication from him is they can stay at current levels for extended periods of time. So I have no doubt, given what happened with the taper tantrum in the United States when the Fed first started to taper its quantitative easing program, that Mario Draghi is going to learn from that and definitely keep the market relatively calm and just provide confidence that he will be there to step in if necessary. So that's to do with the ECB at the moment, and of course this is also supported by the better than expected inflation numbers we saw yesterday. In the core and headline figures. I think they were so the year-on-year 1.5 versus 1.4 expected, and your core was 1.3 versus 1.2% expected. I think that core reading is particularly interesting. Even if we look at the Fed, when their headline inflation was going up, their core was still stagnant. That wasn't really moving. It was maybe edging up just slightly. But what we're seeing in the Eurozone is we've seen headline improve as well to 1.5%, nice and healthy there. Of course, still a while away from its 2%, but especially with the core going up simultaneously, that means that we are seeing broad-based inflation, and they can't then pin this to transitory factors such as oil and food. So, good job to Draghi. Good job to Draghi. I think he's done an excellent job, and let's see how he does over the next quarter or so. Next headline here, Storm Harvey exposes Achilles heel for global energy market. I'd rather look at this this headline here. So Harvey aftermath hits a third of US oil refineries. So what we saw here, as we've been discussing, the price of gasoline as refineries have been closing quite sharply in the face of the storm in America, Storm Harvey. We've seen a third of US oil refineries start to close down. This closing of refineries has therefore meant that the price of gasoline, which is obviously a byproduct of crude and requires refineries to produce, has gone up. And just having a look, one of its highest levels since 2015, trading at about, so just yesterday on Thursday, US wholesale gasoline spiked 13.5% to close at $2.14 a gallon, a 2-year high, and up more than a third from levels before the storm struck, meaning motorists will probably face acute price increases at the pumps in coming weeks. That's interesting because we haven't really heard anything from Yellen as of recently, and we've seen obviously a recovery in sort of your crude oil prices. If we start to see gasoline pick up as well in the face of this storm, of course that would be transitory, but that might just be the catalyst that Yellen needs to finally push through what she's communicated, which is a tightening of the balance sheet and the third rate hike. All in all, I'll be very, very impressed with her if she can pull that off. That's a lot to ask for, given the fact that we only have now 4 months left of the year. So keeping a close eye on this. I think if gasoline prices do increase substantially enough, and this may filter through into your inflation basket just in the nick of time, it'll be quite a cheeky move from her. But it'll be interesting to see if that actually pans out. Okay, that's covered majority of what I wanted to speak about today. Just looking at the week ahead, the day ahead. Sorry, it is non-farm payrolls day. I'm sure everyone is as excited as I am. Again, what does this mean? Well, choppy, quiet price action throughout the morning. No real data coming out in the UK. 9:30, however, we do have UK market manufacturing PMI. That's going to be an interesting number at 9:30, so only about 35 minutes away. But manufacturing makes up about 20 to 30% of the UK economy, so wouldn't be too market moving. I'd definitely still be looking to get out of some positions and keep an eye on it. But the main event, 1:30, NFP. So guys in stage 1, stage 2, and Karen in stage 3. I expect a pound in the cup. I'm not quite sure who won last month. But we've got quite a lot of people here, so it'll be interesting to see who can predict it correctly this time. Just having a look at the charts here. So what we saw is with the US ADP employment change, still at healthy numbers here, nothing really remarkable. Solid job creation across the board, and we've been seeing this month after month. If we look at non-farm payrolls, fine, we had a blip here, but ultimately, 180. You're expected as always around 180. It may go to 175, 170, 185, but just nice ballpark figure of 180 in most recent months. And you can see tracking very healthy, 200, 231. Even if we dip, the average is still very healthy here, apart from this one reading over here. What does this mean? Well, jobs are continuing to be created, and we know this. The argument, however, I think, particularly now, because everyone's getting a bit sour of the fact that we're continuing to see job creation but no real inflation. What I feel this means is if we're continuing to see jobs be created at a very healthy level month after month after month after month, and we don't see this filter through into an increase in average hourly earnings, then actually we're not near full employment. Because if we were near full employment, you would need to offer higher wages because there would be less workforce available, and that less workforce available would then need an incentive to leave their current job and move to the new job. So what we're seeing is average hourly earnings are basically staying stagnant. They're not really increasing, whilst we're continuing to see job growth. So I think the argument of whether or not we're reaching maximum employment, understandably we're at around 4.4%, so healthy numbers, but the metrics don't line up. Maybe maximum employment is now lower. Maybe it's 4, maybe it's under 3.5%. Maybe, 3.5%, 4%. I think we'll start to realize what maximum employment is now post-financial crisis when we start to see a more linear move in average hourly earnings and employment. When we start to see a good jobs number filtering through into higher average hourly earnings over the next few months, at that point we can then put forward the argument that we're now in a maximum employment. So that's what I feel at the moment. But again, the jobs number we're not concerned with. The market's expecting a good number. Even if we get a bad number, I don't really feel like this is going to change anything. Having a look at your average hourly earnings, just quickly pull the charts up. Average hourly earnings month on month for August. So yeah, just we've hit a wall for the past 12 months, 0.3%. So I think if we get, in terms of my ranges, 0.2%, fine, not so great. That coupled with a bad jobs number, we may see a continuation of this dollar weakness. But that will largely be led by the fact that average hourly earnings were disappointing than a bad jobs number. However, if we start getting a number around 0.4%, I think this is exactly what the market needs right now. If we see the number come out at 0.4% plus a solid job growth, we're going to see an immediate rise in yields. My personal opinion, I discussed this last week, we've underestimated the hawkishness of Yellen. I think that she is going to pull through and manage to hike. But in terms of broad-based belief in this will come if we see a 0.4% reading in the average hourly earnings. And of course that will be exacerbated further if we start to see a really good jobs number as a whole. So 0.4 being my upper bound, 0.2, well, it's saying the consensus here is 0.2, so then therefore the lower bound would then have to be 0.1. So your spread is basically the whole year. It's one of your lowest readings for the year and the highest readings for the year. And just having a quick flick back over to the dollar yen just to see where we're positioned. We've seen some recovery in the dollar. I think that's more profit taking ahead of non-farm payrolls. Yeah, so we have seen this bout of dollar strength over the past couple trading sessions, as well as money flowing out of the yen as we've seen that US equity market recover. But otherwise, the dollar has been just weakening consistently since basically beginning of this year. If we go back to January, we've seen the Fed watch tool. Market's not priced for a Fed hike. So once again, I think the best mover today will be if we see an average hourly earnings of 0.4% or higher. This will also coupled with a relatively inline, slightly positive PCE readings we saw yesterday. Okay, guys. So in the morning, once again, it's going to be nice. It's going to be quiet. So keep your wits about you. Maybe look to play the range. September's here. We may see a pickup in volume. I'd be looking for some statistics. Actually, I'll put them in Trading Live when I find them, as to if we've seen the volume start to increase in the markets. But otherwise, thank you very much, guys. Feel free to drop me any messages in Trading Live. Thank you very much.